DataVolt AI, that's DVLT, after their huge Q3 earnings report dropped.
The one with that massive guidance raise and the strong buy rating.
Exactly. The piece lays out the catalyst clearly. The 148% revenue growth, that $10 million Silex deal, it's all there.
It is, but let's jump right in. I think the core of this critique is about adding the analytical rigor needed to support that massive valuation leap.
I completely agree. So, first point, to really elevate this analysis, it has to bridge the gap between current revenue and that massive future guidance. You have to manage reader skepticism.
Right.
Because the report, it presents that new 2026 guidance, the $200 million, as just a purely positive fact.
With no real mechanism, is there? I mean, how do you get from $2.9 million in a quarter to that? For a sharp reader, that's a huge analytical gap.
So what's the suggestion here?
Well, the opportunity is to just integrate a brief, high-level discussion on how scalable these new deals actually are.
Like, is that Silex deal a one-off or something they can do again?
Precisely. Is that $10 million agreement a repeatable template, or is the entire $200 million projection banking on one single massive regulatory approval? Just defining that makes the number feel robust, and it outlines the risk profile.
And that risk profile leads right into the market's own reaction. So a more balanced analysis here really needs to address the market's immediate reservations, which you can see implied by that big stock price retraction.
It's such a crucial data point. The analysis celebrates the spike up to $2.19, which is fine, but it really underplays the significance of the close at $1.87.
That's a pretty big pullback.
It's a sizable pullback. It suggests immediate skepticism, or at least a lot of profit-taking after that initial pop. The tone is just a little too bullish.
So the fix is to tackle that head-on.
Absolutely. Acknowledge it, and then, hypothesize why investors might have sold off so fast. Maybe the market felt that $3 target was already partly priced in, or maybe the lack of detail on spending fueled some uncertainty. Exploring that hesitation strengthens the whole piece.
Right, and if we can't fully justify the growth, it's pretty hard to justify that price target. Which brings us to our last point.
They all tie together.
To strengthen the report for a sophisticated audience, you have to translate those aggressive revenue projections directly into a clear valuation argument. You can't just cite the strong buy rating.
Yeah, the material relies way too heavily on that analyst's $3 price target without explaining the fundamental math that connects a $200 million guidance to that specific price.
You have to show the work.
You have to show the work, explicitly connect that guidance to some real valuation metrics. I mean, just briefly mention what forward price to sales multiple that $3 target implies.
Based on the new guidance, of course.
Based on the new $200 million guidance. Then, and this is the key part, benchmark it. Is that multiple in line with other companies growing at 148%? That shows the reader the thinking behind the confidence.
So to wrap this all up, the actionable advice is really about adding that next layer of analytical depth. First, justify the path to $200 million by discussing deal scalability. Second, critically examine the reasons for that intraday pullback from $2.19 to $1.87.
And third, explicitly show how the guidance actually supports that $3 price target using clear valuation metrics.
This is an exciting stock story, and it's built on some really strong reported numbers.
It is. The key is just to add the how and the why behind those massive future numbers. If you refine that strategic narrative, this will be an excellent piece. We'd love to see the update.